Most traders lose money not because they choose the wrong direction, but because they are obsessed with having one. They wake up asking, is the market going up or down? As if survival in trading depends on becoming a prophet. But the market has never paid people for certainty. It pays people for seeing what is there. Think about that for a moment. How many times have you entered a trade not because price gave you a reason, but because your mind demanded a story? You wanted a bias. You wanted a prediction. And once you had it, everything afterward became filtered through that belief. Now here is the strange part. The market does not care about your need for direction. It moves through periods of expansion and contraction, confidence and hesitation, aggression and pause. Yet many traders walk into every session carrying a fixed opinion. Why? Because uncertainty feels uncomfortable. The mind would rather be wrong with conviction than patient without answers, and that creates a chain reaction. You form an opinion, then you defend it. Because you defend it, you stop observing. Because you stop observing, you stop adapting. And once adaptation disappears, the market begins pulling money out of your account, one small mistake at a time. Have you noticed how the cleanest trades often appear when you are not trying to force them? Think back. The trade unfolds, conditions line up, and action feels almost simple. There is no wrestling match inside your head. Why is that? Because you were following behavior instead of prediction. Trading without direction does not mean trading without thought. It means refusing to marry an idea before the market has spoken. There is a difference, a very important difference. When price approaches a level, do not ask, will it break? Ask, how is it behaving here? Is momentum increasing? Are reactions becoming weaker? Are buyers pushing and getting little progress? Watch the behavior, because behavior leaves footprints. A trader looking for direction sees only outcomes. A trader studying behavior sees process. One asks where price will go. The other asks what participants are doing, and participants reveal themselves through hesitation, speed, failed moves, and repeated tests. So, what should you actually look for? Watch how price responds after strong movement. Does it continue or does it struggle? Look at failed breakouts. Markets often tell the truth through failure before they tell it through success. Pay attention to effort and result. Heavy movement with little progress means something is changing beneath the surface. And what should you avoid? Avoid the urge to fill every silence with an opinion. Avoid entering because you are tired of waiting. Waiting feels unproductive to impatient traders, but waiting is observation. Observation is information. Ask yourself, if you removed your bias completely, what would the chart actually be saying right now? Most traders walk into the market carrying a question that quietly controls everything they do. Where is price going? They want direction before they want information. They want certainty before they want evidence. And from that moment, the problem begins. Because direction is often a desire, not a requirement. Think about it. How many times have you opened a chart and immediately felt the need to decide whether you were bullish or bearish? Almost instantly, the mind starts working. It begins searching for reasons, collecting signals, building a case. If you think the market should rise, you start noticing strength. If you think it should fall, suddenly weakness becomes easier to see. But are you seeing the market at that point? Or are you seeing your own expectations? That difference matters more than most traders realize. The mind dislikes uncertainty. It wants a clear road, a fixed answer, something solid to hold on to. Trading places you directly against that instinct because markets spend a surprising amount of time doing things that are unclear. They hesitate. They shift. They pause. They move strongly and then suddenly lose energy. Yet many traders refuse to allow uncertainty to exist. They immediately replace it with a prediction. And once prediction enters the picture, behavior changes. A trader who needs direction starts defending ideas. If they decide the market is bullish, every pullback becomes just a retracement. Every sign of weakness becomes something to explain away. They are no longer observing. They are protecting a belief. Have you ever noticed yourself doing that? Holding onto a trade because the original idea felt convincing. Watching price give warning signs, but refusing to accept them because changing your mind felt like admitting defeat. That is what attachment looks like. The market does not ask whether you are committed to your opinion. It simply keeps moving according to the behavior of participants. Buyers step in. Sellers respond. Pressure builds. Momentum fades. None of this happens because your analysis wants it to happen. And that is where many traders create unnecessary pressure for themselves. They believe they must always know what comes next. They believe a skilled trader wakes up every morning already knowing where the market will go. But experienced traders often operate differently. They do not rush toward certainty. They stay close to observation. Instead of asking, where is price going? They ask, what is price doing right now? There is a quiet difference between those two questions. One question pulls you into imagination. The other keeps you connected to reality. Imagine price approaches a major level. Most traders instantly begin predicting. This level will break. This level will hold. The mind chooses a side. But what if you waited? What if instead you watched how price behaved around that area? Is movement becoming aggressive? Is momentum slowing? Are reactions becoming smaller? Is price being accepted or rejected? Because behavior tells stories long before direction becomes obvious. Direction is often the thing traders chase first, but the market rarely hands it out immediately. It leaves clues. It leaves footprints. It reveals strength and weakness through action. The problem is that traders searching desperately for direction often miss those clues entirely. Most traders think price moves first and information comes later. They believe the market suddenly decides to run upward or collapse downward, and everyone reacts after the fact. But if you watch carefully for long enough, you begin to notice something different. Price often speaks before it moves. Not with words, not with predictions, through behavior. The problem is that most people are waiting for obvious events. They want the breakout candle. They want the explosive move. They want confirmation that leaves no room for doubt. But by the time movement becomes obvious, a large part of the opportunity has often already developed. So the question becomes, what happens before the move? Have you ever watched a market that looked strong, but something felt different? Price kept pushing higher, yet each move seemed to lose energy. Progress became smaller. Momentum started fading. Buyers were still present, but the effort began looking heavier. At first glance, nothing appears wrong. Most traders continue believing the trend remains healthy because they are focused on direction. They see higher prices and assume strength still exists. But behavior can tell a different story. Think about effort and result. If price requires increasing effort just to make smaller progress, something underneath may be changing. Pressure may be building where most people are not paying attention. Now reverse the situation. Imagine a market under heavy selling pressure. Red candles continue appearing, fear begins spreading, and traders become convinced that lower prices are inevitable. But suddenly price stops falling with the same force. Selling still exists, yet movement begins slowing. Pushes downward create less distance. What changed? Sometimes nothing visible changed at all. No major news, no dramatic event. Yet behavior shifted. Price was speaking. The market leaves traces before major movement develops, because every move is created by participation. Buyers and sellers do not appear all at once like flipping a switch. Their activity builds gradually. Strength enters, weakness enters, aggression increases, conviction fades. Those changes often become visible before direction becomes obvious. But many traders miss this because they are waiting for certainty. They want proof that cannot be questioned. The problem is that markets rarely operate that way. They communicate through small details first. Have you noticed how failed breakouts can reveal more information than successful ones? Price pushes through a level, excitement builds, traders rush into positions, and then suddenly price falls back. Why does that matter? Because failure itself contains information. If price cannot continue after attracting participation, something important may be happening beneath the surface. Strength may not be as strong as it appears. Demand may not be keeping pace with expectations. Price was already speaking. Watch repeated tests of important areas. Watch reactions become weaker or stronger. Watch how quickly price recovers after sharp movement. Watch whether momentum expands or contracts. Do not only ask where price is moving. Ask how it is moving. Most traders believe the biggest threat to their account is the market itself. They think losses come from volatility, unexpected news, or choosing the wrong setup. But often the problem begins much earlier, in a place most people do not examine. It begins with bias. Because bias creates blind spots. The dangerous thing about bias is that it rarely feels dangerous while it is happening. It feels intelligent. It feels reasonable. It feels like conviction. You tell yourself you have done the analysis, studied the chart, understood the situation. Everything appears clear. But clarity and correctness are not always the same thing. Have you ever entered a trade and suddenly started noticing only information that supported your position? You buy, and every bullish candle catches your attention. Every sign of strength feels important. But signs of weakness somehow become less noticeable. Or maybe you sell, and now every pullback looks like confirmation. Every negative signal appears meaningful, while opposing evidence slowly disappears from your attention. Did the market change? No. Your vision changed. That is what makes bias difficult to recognize. The chart stays the same, but the way you process it begins shifting. Instead of observing reality, you start protecting an idea. And once that happens, behavior changes in ways that quietly damage decision-making. A trader with strong bias stops asking questions. They begin searching for agreement instead of truth. They stop listening to what price is doing and start listening only to what supports their expectations. Because the mind likes consistency. Once people commit to an opinion, changing that opinion becomes uncomfortable. It feels like weakness. It feels like being wrong. So instead of adapting, they defend. Now think about what that creates. Price starts moving against the trade, but warning signs become easier to ignore. Momentum weakens, but the trader tells himself it is temporary. Important levels fail, but explanations appear immediately. It will come back. The market is just shaking people out. I just need to hold a little longer. Have you noticed how easy it is to become an expert at explaining away information when money is involved? Because bias does not only change what you see, it changes how you interpret what you see, and over time, small blind spots become expensive ones. Imagine driving with part of your windshield covered. You can still see the road, you can still move forward, but important details disappear. Maybe you miss a turn, maybe you miss a warning sign, maybe you react too late. Bias works the same way. The problem is not that you see nothing. The problem is that you think you see everything. Experienced traders understand something important. Their goal is not to prove themselves right. Their goal is to stay aligned with reality. Those are two different missions. So before asking where the market might go, ask something else. What am I refusing to see right now? Look for information that challenges your idea. Pay attention to behavior that does not fit your expectations. Notice when you feel emotionally attached to an opinion, because attachment often reveals bias before the chart does. Most traders spend their time chasing explanations. They want a story behind every move. They want reasons, headlines, opinions, and predictions. If price rises, they want to know why. If price falls, they search for an answer immediately. But markets have a habit of teaching a difficult lesson. Stories often arrive after movement begins. That is why learning to read behavior matters more than following narratives. Have you ever noticed how two traders can look at the same chart and walk away with completely different opinions? One sees strength. Another sees weakness. One expects continuation. Another expects reversal. How can that happen if they are looking at the same market? Because many people are not studying behavior. They are studying their own interpretation of events. A narrative gives comfort because it creates certainty. It gives the mind a simple explanation to hold on to. The market is bullish because of this news. The market is weak because of that event. Suddenly everything feels organized. But markets are rarely that simple. Price can rise during bad news. Price can fall during good news. Expectations shift. Participants react differently. Money moves for reasons that are often invisible in the moment. Behavior, however, leaves evidence. It does not ask for opinions. It simply shows what participants are doing. Imagine price reaches an important level and immediately pulls back. Then it returns again. Then again. At first, many traders see only repetition. Nothing appears unusual. but behavior may be revealing something important. Repeated testing can show growing pressure. Buyers may be becoming more aggressive. Sellers may be losing strength. Something beneath the surface could be changing long before direction becomes obvious. Now imagine another situation. Price breaks above resistance with a large move. Excitement enters the market. Traders rush in because the narrative becomes easy. The breakout is here, but then price stalls. Momentum begins slowing. Follow-through becomes weak. Price struggles to continue despite the initial burst of energy. What is behavior saying? Because behavior and narrative do not always agree. The narrative says strength is expanding. Behavior may be saying enthusiasm is fading. Have you noticed how traders often become trapped after a strong move? They enter late because emotion and stories become louder. Everything suddenly feels certain. The move becomes easy to understand, but the market had already been speaking before that. Small clues were there. Reactions, failed pushes, momentum shifts, repeated tests. The information existed before the explanation became popular. That is why experienced traders often appear calmer. They are not trying to predict every move. They are paying attention to what price is actually doing. Watch how quickly price moves away from important areas. Watch whether pullbacks become shallow or deep. Watch whether effort creates meaningful progress. Because effort without result matters. Strong movement that produces little progress matters. Failed moves matter. Weak reactions matter. Do not become too interested in what people are saying about the market. Become interested in what participants are revealing through action. Because narratives can change overnight. A new headline appears, a new explanation forms, and suddenly everyone begins repeating a different story. Many traders believe consistency comes from having strong opinions. They think successful trading means developing certainty, standing firm, and sticking to a view no matter what happens. They admire confidence because confidence looks powerful. But markets teach a different lesson. The market rewards flexibility. At first, that sounds almost strange. People usually connect flexibility with hesitation or weakness. They imagine someone constantly changing their mind, moving without conviction, reacting emotionally to every small movement. That is not flexibility. Flexibility is the ability to respond when evidence changes. There is an important difference. Have you ever entered a trade that looked perfect at the beginning? Everything aligned. The setup made sense. The timing felt right. The logic was clear. Then price started behaving differently. Not dramatically, just small changes. Momentum weakened. Reactions shifted. Progress slowed. But instead of adapting, you stayed committed because changing your mind felt uncomfortable. Why? Because once money and emotion become attached to an idea, people naturally want that idea to survive. They begin treating a trade like something that must be defended. And that creates a problem. A trader who becomes rigid starts seeing adjustment as failure. Every new piece of information becomes a threat instead of useful feedback. Imagine driving toward a destination and suddenly seeing signs of heavy traffic ahead. A flexible driver changes direction. A rigid driver keeps moving simply because that was the original plan. Who reaches the destination faster? The answer seems obvious in everyday life. Yet traders often do the opposite. They create a plan before the session begins and become emotionally tied to it. They decide the market should move upward or downward, and after making that decision they stop observing. The market changes. They do not. And that gap between changing conditions and fixed thinking begins creating losses. Because markets move through different environments. Some days expand with strong momentum. Some days contract into slower movement. Some days reward aggression. Other days punish it immediately. Have you noticed how a strategy can feel effortless one week and frustrating the next? Most traders assume something is wrong with the strategy itself, but often the environment changed while the trader stayed the same. Flexibility means recognizing that conditions matter. Watch how price responds to movement. Is momentum expanding or fading? Are breakouts continuing or failing? Are pullbacks shallow or becoming deeper? Those details matter because behavior shifts before results become obvious. A flexible trader notices changes early. A rigid trader notices only after damage appears. That does not mean abandoning every idea at the first sign of difficulty. Markets create noise. Small fluctuations happen constantly. Flexibility is not panic. Flexibility is staying connected to reality. Ask yourself something. If the market gives information that directly challenges your expectation, how quickly are you willing to listen? Because many traders secretly negotiate with reality. They ask for one more candle, one more move, one more chance for the market to agree with them. But markets do not reward loyalty. They do not care how strongly you believe in an opinion. They reward people who can observe, adjust, and respond without becoming trapped by their own certainty. Most traders believe execution is where money is made. They focus on entries, exits, risk, and timing. They spend hours looking for the perfect setup, the perfect signal, the perfect moment to click the button. But the trade itself is often the final step, not the first one. Observation comes before execution. That sounds simple, yet many traders reverse the process without realizing it. Have you ever opened a chart and immediately started searching for a trade? Not information, not behavior. A trade. Your eyes begin scanning for patterns, levels, indicators, anything that gives you permission to act. Notice what happened there. The mind already decided that action was necessary. And once action becomes the goal, observation starts losing its value. Because when people want something badly enough, they begin seeing it everywhere. A trader eager to buy finds reasons to buy. A trader looking to sell finds reasons to sell. Suddenly the chart becomes less of an environment to understand and more of a place to justify decisions. That creates a dangerous shift. You stop asking, what is happening? You start asking, how can I enter? There is a difference between those two questions, and that difference quietly separates patient traders from impulsive ones. Think about a hunter in the wild. A hunter does not run blindly through the forest hoping something appears. He watches movement. He notices patterns. He pays attention to changes that others might miss. Observation comes first because information creates better action. Trading works the same way. Price is constantly revealing information, but it does not reveal everything at once. It leaves small clues. Momentum changes. Reactions shift. Buyers become stronger or weaker. Sellers become more aggressive or less effective. The problem is that many traders never slow down long enough to notice. Have you ever entered a trade and seconds later realized you missed something obvious? Maybe price was approaching a major level. Maybe momentum had already started fading. Maybe previous reactions were showing hesitation. The information was there, but attention was somewhere else. Because the mind becomes impatient. Waiting feels uncomfortable to many traders because waiting feels inactive. They stare at the screen and feel pressure building. Minutes pass without action, and suddenly observation starts feeling like wasted time. So they force execution, and forced execution usually creates predictable results. Poor entries appear, risk increases, emotions become stronger. Then frustration arrives, not because the market behaved unfairly, but because the process started in the wrong order. Execution without observation becomes reaction. Observation without urgency creates understanding. Have you noticed how the best trades often feel quieter than expected? There is less internal conflict, less pressure, less need to convince yourself. Why? Because by the time execution happens, observation already did most of the work. The decision becomes clearer because information had time to develop. Watch how price behaves around important areas. Watch whether movement accelerates or slows. Watch how participants react after strong moves. Notice repeated failures and repeated tests. Do not rush to interpret every candle. Let behavior build a picture, because markets rarely hide information completely. They reveal it gradually. Most traders become excited when the market succeeds. A breakout succeeds, momentum expands, price accelerates, and confidence rises instantly. People love confirmation because confirmation feels safe, but markets often reveal more through failure than through success. Failed moves reveal hidden intent. That is where many traders stop paying attention too early. Have you ever watched price break through a major level and felt immediate certainty? Resistance breaks, buyers rush in, momentum increases, and suddenly the move looks obvious. Everyone sees the same thing at the same time. Then something strange happens. Price stops, momentum slows, the breakout that looked powerful begins struggling to continue. At first, many traders ignore it. They assume the market is simply pausing before the next move higher. But as time passes, progress disappears. Buyers who entered late start feeling trapped. Price slips back below the level. Now ask yourself something important. If the breakout was truly strong, why did continuation disappear so quickly? That question matters because failure carries information. A failed move often exposes weakness hiding beneath confidence. It shows that participation may not be as committed as it first appeared. The market attempted something and could not sustain it. That failure itself becomes evidence. Think about how people behave emotionally around failed moves. Traders who entered aggressively begin feeling pressure. Some hesitate. Some panic. Some rush to exit positions all at once. And those reactions create movement. The market is not just numbers moving on a screen. It is pressure, expectation, fear, confidence, hesitation. Failed moves expose those emotions clearly because they force participants to confront reality quickly. Have you noticed how strong reversals often begin after obvious failures? There is a reason for that. A market pushing into resistance and instantly rejecting tells a story. A breakout failing repeatedly tells another story. A strong move that cannot attract follow-through reveals something important about conviction. The crowd usually focuses on what happened. Experienced traders focus on what should have happened but did not. That difference changes everything. Imagine price breaks above a major level with strong momentum. Under normal conditions, continuation should appear. Buyers should defend the breakout. Progress should expand. But instead, price hesitates. That hesitation matters, because markets tend to reveal weakness through inability. Not always through dramatic collapse, but through failed continuation, weak reactions, and stalled momentum. Now reverse the situation. Imagine price breaks downward aggressively. Fear spreads. Selling pressure increases. Yet despite heavy selling, price struggles to continue lower. Why? Because behavior may be changing beneath the surface. The move failed to produce the expected result. And whenever expectation and outcome stop matching, attention becomes important. Many traders lose money because they chase movement after it becomes obvious. They enter emotionally after seeing strength or weakness already displayed publicly. But by then, the more useful information may already exist elsewhere. In the failure, watch failed breakouts, watch failed breakdowns, watch moments where price attempts to continue but suddenly loses energy. Do not only study successful movement, study what the market could not accomplish. Most traders think patience means doing nothing, sitting still, waiting passively, watching the screen until some perfect setup magically appears. But real patience in trading is not passive at all. Patience is active, not passive. That distinction changes the entire meaning of waiting. Have you ever noticed how difficult it feels to stay out of the market? Even when conditions are unclear, even when movement looks messy, the urge to act slowly starts building inside the mind. You begin searching harder, interpreting random movement as opportunity, convincing yourself that something is about to happen. Why? Because many traders associate activity with productivity. If they are entering trades, adjusting positions, constantly making decisions, they feel involved. They feel like they are working. But trading does not reward activity alone. In fact, unnecessary action often becomes the source of unnecessary losses. The market creates endless movement every day, but not all movement deserves participation. Some sessions are clean and organized. Others are noisy, emotional, and directionless. Yet impatient traders approach both environments the same way. They feel pressure to trade simply because the market is open. That pressure quietly destroys observation. Because once the mind becomes desperate for action, patience disappears and emotional decision-making takes over. Now think about what active patience actually looks like. It means staying mentally engaged without forcing execution. It means observing behavior carefully while resisting the urge to predict too early. It means allowing information to develop before committing capital. That is not passive. A patient trader is constantly studying conditions, watching momentum, watching reactions, watching how price behaves around important levels. They are involved, but not emotionally trapped by the need to participate immediately. There is a difference between waiting with attention and waiting with frustration. One creates clarity, the other creates impulsiveness. Have you ever entered a trade mainly because you were tired of waiting? Maybe nothing truly aligned, but enough time passed that sitting still started feeling uncomfortable. So you took the trade almost to escape the boredom itself. That happens more often than traders admit, because inactivity can feel emotionally difficult. The mind starts asking dangerous questions. What if I miss the move? What if this was the opportunity? What if everyone else sees something I don't? And suddenly fear of missing out begins replacing objective observation. But here is the irony.